Hello and welcome to this session in which we will discuss how the right-of-use assets and lease liabilities are presented on the financial statements. Specifically, what are the financial statements? The balance sheet, where we list assets and liabilities, the income statements, where we have revenues and expenses, and the cash flow statements. In addition to the numbers, we have to have additional disclosure that explain the figures that are presented on the balance sheet. For the disclosure, I will have a separate recording, not to have this session for too long. So this way, focus on the numbers, then disclosure will be presented separately. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Starting with the balance sheet, as I mentioned, on the balance sheet, we list assets. So the right-of-use assets are listed there. And obviously the liabilities, the lease liabilities. Now, assets and liabilities can be shown as individual line item in the appropriate section. So each one separately, like we could have more than one lease liability, more than one right-of-use assets, or they can be combined with similar items. Now, bear in mind, we still need the disclosure. We need the disclosure. We'll talk about the disclosure later because we need to include them in the proper section as well as any additional information to clarify what are these numbers, assets and liabilities, whether the liability is short-term or long-term. So lease liabilities that are due within 1 year or the business operating cycle are listed as current liabilities. And sometimes you might be only asked on a question, what is the current portion of the lease liability? You want to make sure you know this. With the remaining balance of the lease liabilities is long-term. So what I'm trying to say is this: lease liabilities, if they are long-term, and mostly they are long-term, part of it will be short-term, part of it will be long-term. And sometimes you might be asked to identify which one is the short-term or which one is the long-term, or sometimes you might want to know what is the total lease liability presented on the balance sheet. Now, bear in mind, you have to separate the presentation of the finance and operating lease assets and liabilities. Those should not be combined. So if you have right-of-use asset under a finance lease, right-of-use asset under an operating lease, you have to show those separate. Those are not the same, although they're both assets. Same thing with liabilities. Now, bear in mind that the value of the asset diminishes, gets depreciated, specifically gets amortized over time. And what happened to the liability? The liability will decrease as it goes down over time because you are paying the principal. So both the asset goes down and the liability goes down. Now the question becomes, when it comes to the asset, how do we amortize? How do we amortize, or for how long do we depreciate the right-of-use asset? Again, if I use amortization or depreciation, they mean the same thing. So I'm going to say the depreciation of the right-of-use asset begins on the start date of the lease. Generally speaking, we're going to be using the straight line, except unless there is a justification where we would use an alternative approach other than the straight line that capture the asset use. Otherwise, we always assume the straight line. Now, the question is for how long? When we depreciate something, over how long? Well, now we're going to go back and review our criteria for deciding if a lease is a finance lease or not. You remember there are 5 criteria. Let's go over the first 2. If the lease agreement result in the lessee owning the asset at the end of the lease, or if there's a bargain purchase option, that's why we have a finance lease, the amortization period should extend over the asset expected lifespan. Simply put, if at the end of the lease you're going to own the asset, or at the end of the lease you have a bargain purchase option, what does that mean? In both situations, you are going to be owning the asset, because it's either you're going to own it or you're going to buy it because the deal is so good you're not going to pass it. If that's the case, you amortize, you depreciate this right-of-use asset over the asset expected lifespan. So the lease agreement is irrelevant. Why? Because you are going to own the asset. Therefore, the asset is yours. You would depreciate or amortize the asset over expected lifespan. So this is assuming those two options exist. How else can you one of them? They don't have to be two. How about if the lease is a finance lease because of the lessee's present value, which is 90% of the fair value of the asset, or you have a lease, it's a finance lease because the asset economic life is 75% or more, or you have a finance lease because the asset is so specialized. The other three options to have a finance lease. Well, what do you do if those three other options, lease, present value, economic life, or the asset is so specialized? If you have a finance lease based on that, how do you amortize this asset? Well, you're going to amortize it the shorter of these two options, either the lease duration or the asset estimated useful life. So you find the shorter one. If the lease is shorter, you use the lease life. So let's assume the lease duration is 7 years and the asset life is 10 years. Well, which one is the shorter? The lease duration. So you would amortize the asset over the lease duration if you are capitalizing the lease based on present value factors, asset economic life, or if the asset is a specialized asset. Those are criteria 3, 4, or 5. And remember, under criteria 1 and 2, it's easy, over the expected life of the asset. Let's take a look at a quick example. XYZ Corporation enters into a lease agreement with ABC Rental for a piece of manufacturing equipment for a period of 6 years. The lease does not include a clause to transfer the ownership to XYZ. So remember, this is criteria 1 is out, the ownership. Nor it does offer XYZ Corporation the option to buy the equipment. So no bargain purchase. Option 2 is out. However, the present value of the lease payment amount to almost the entire fair value of the equipment. Almost means more than 90%. And the equipment accounting useful life is 10 years. So we have a lease of 6 years, life of 10. So what do we need to know now? Well, we cannot amortize this lease over the using criteria 1 or 2. It means the asset life is out for now based on criteria 1 and 2. We have to use criteria 3, 4, or 5, which is, they already told us, it's basically criteria 3. The present value represents a substantial amount of the fair value. What does that mean? We have a finance lease. Because the present value of the lease payment is substantial, what does that mean? It means we qualify under that category. Given this classification, we will amortize the right-of-use asset over the shorter of the lease term or the asset life. Well, the asset life is 10 years, so the asset life is 10, the life is 10, the lease is 6. What do we use over the shorter of the two? The shorter of the two is 6 years. So given the classification, XYZ Corporation will amortize the right-of-use asset over the lease term of 6 years because it's shorter than the life of the asset. Let's move to the income statement. For operating leases, remember, we have finance lease, operating lease. Remember, we only have one expense. The total cost of the lease is reported as lease expense. Now, if you don't know what does that mean, you got to go back and learn operating leases. At this point, I assume you know what's an operating lease. Within income from continuing operating section of the income statement. Simply put, the lease expense is part of your operating expense. And this approach spreads the lease cost evenly across the lease period, which is basically a straight line method. That's what you're doing it. Well, guess what? It's a regular operational expense. Simply put, your lease expense, it's part of your operation. It's an expense. How many expense do we have? We have one expense under an operating lease, and it's called lease expense. Now, this lease expense include both amortization and interest, in quote interest, but it's shown under lease expense. For finance expense, however, it's different. The expense recognition in the income statement is divided. Is divided between what? It's divided between interest component and amortization component. One component is the amortization of the asset, which is an amortization, it's included in the operating section. Think of depreciation. How do you report depreciation? You report depreciation under the operating section. There's no surprises here. The other component is the interest expense. Because we have a lease liability, we have an interest expense. Well, it's under financial expenses or operating the business. This method does what? Separately account for the asset depreciation or amortization and the finance charge, offering more detailed view of the lease financial impact. Simply put, the interest is not part of your operation. It's part of financing the operation. It's part of your interest expense because we are calling it interest expense, therefore it's listed with the interest expense. Under the operating lease, we don't have interest. Everything is under lease expense, under operating section, the amortization under operation section. However, the interest expense is interest. Interest is separate. Since we are listing it separately for a finance lease, it gets listed separately on the income statement. How about the cash flow statement? First, we're going to look at an operating lease. Remember, in an operating lease, all the payments are called what? They are called lease expense. So for all lease payment, including those that vary on factors like usage or performance, what are they do? They are operating, therefore they are part of the cash flow from operation. So for operating leases, we're going to report the payment under the operating section of the cash flow statement. And this is because the expense, the payments that we are making are part of the day-to-day operation. They're operating the business. Also, payments for leases that are short-term, defined in less than 12 months, are also recorded under operating expenses because it's an operating lease, assuming there are no purchase agreement there. Also, an initial payment made to prepare the leased asset for its intended use, such as modification or relocation expenses, are not considered part of the routine operational expense. Instead, those are treated as investing activities because they're not part of operating the lease yet. We're still building the asset. We're purchasing the asset. It's an investment. They represent one-time investment in the asset to make it ready for its intended use. So any cost other than the lease expense, means cost that we incur before to get the asset ready, the lease ready, those are investing. So this is for operating leases. So the payment, the regular payment, operating expenses. Any payment before, it's investing. I apologize, not financing, investing. So on the investing section, because you're investing in an asset, investing activities. How about if we have a finance lease? Remember, under the finance lease, we have two payments. One is for interest and one for amortization. So the principal portion of each lease payment, which contribute to settling the liability, is a finance lease. Here what we're looking at is interest. Not interest, the payment. When we make a payment, the payment under a finance lease, part of it is interest, part of it is principal amount, which is the liability. The part of the payment that settles the liability, that reduces the liability, is part of your financing. And this reflects what? The lease financing aspect and the reduction in the financial obligation. There should be no surprise here. When you reduce your liability, it's part of your financing activities. The interest component of the lease payment, remember we have interest component, is considered an operational expense and thus be classified under operating expenses. Remember, we're dealing with US generally accepted accounting principle. Interest is part of your operation. So the portion represents the cost of financing the lease. Nevertheless, it's part of your operation. Any variable lease payment or payment for short-term leases that are not included in the initial measure of the lease liability are treated as operational cash flow. They are considered operational expenses. That's fine. Operating leases are seen purely as operational expenses, whereas finance leases are recognized for their financing component and their operational expense. So if it's an operating lease, operating expense, it's what? It's part of your operation. The finance lease, remember, you have two components, an interest component and a principal component. The principal component is part of your financing. The interest component is part of your operating cash flow. So to summarize, if we have an operating lease and we're only dealing with the lease payment, it's cash flow operating. Those are the payments. operating lease, cash flow operating should make sense. If we're dealing with a finance, let me write this better. If we're dealing with a finance lease, remember the finance lease will have the payment is broken down into interest, which will be also operating just like the operating section here, because interest is part of operating based on GAAP. And we have the principal component, which is what? Which is not investing, financing. Financing section, when you pay down your liability, it's financing. Let's take a look at this multiple choice questions from farhatlectures.com. For a finance lease, so we're dealing with a finance lease, how should the right-of-use asset be amortized if the lease does not transfer ownership to the asset of the asset to the lessee and there's no purchase option? So we have a finance lease, but that lease is it's not a finance lease because it transfer ownership or the bargain purchase option. So if we look at the 5 criteria, 1, 2, 3, 4, 5, the first criteria is the ownership. So it's not based on the ownership. The second criteria is the bargain purchase. So those two are not. So it's a finance lease because 90% of the payment represent the fair value, more than almost substantial amount of the fair value, which is when you look at the present value of the payment, or 75% of the asset lease life is part of the lease, or the asset is a specialized nature. So it's a finance lease because of those 3 options. If it's a finance lease based on those 3 options, how do we amortize the right-of-use asset? Over the lease term using the double declining balance. Well, it could be the lease term, but definitely it could be, but it's not double declining balance, because which method do we use? Straight line. That's one. A is out. Over the shorter of asset useful life or the lease term using the straight line. The straight line, yes, we use the straight line. Is it over the shorter of the asset useful life or the lease term? This sounds right. This sounds right. So when we have a lease and it's a finance lease because 90% of the payment represent 90% or more of the fair value of the asset, or the asset lease life represents 75% of the asset life, or if it's a specialized nature, yes, B is a good answer, but let's look at C. Over the asset useful life using the straight line, it could be, but not necessary. It could be, but not necessary. Because what about if the lease term is shorter? We go with the lease term. That's why C is tricky. It should not be amortized since the asset is not owned by the lessee. It's not owned by the lessee, but nevertheless, we're going to amortize it. D is out. Therefore, the answer is B as in boy. Over the shorter of the asset useful life or the lease term using the straight line. Now remember, if it's a lease asset because of point 1 and 2, the ownership transfer, and there's a bargain purchase, it's the asset life. We just look at the asset life because we are going to own the asset. What should you do now? You want to go to Farhat Lectures, look at additional MCQs, additional resources that's going to help you, whether you're studying for your CPA exam, taking accounting courses, studying for some sort of a professional certification. Invest in yourself. Good luck, study hard, and of course, stay safe.